I saw a lot of issues in my later days on the lending side, just given the sheer exposure that the industry had from a variable rate perspective, where they were coming in, putting 80 to 85% levered debt in place with no rate caps when rates were effectively zero. Obviously, LIBOR, which is now SOFR, has ripped and caught people off guard. So, the largest expense in your P&L overnight became your debt service. And sometimes 2, 3, 4x what it was when you originated the loan, right? So a lot of these folks didn't project this out. They didn't perform their, assumptions 2, 3, 4 years later and have an interest rate go from 3 to 8 or 9%. And so as a result, that tightened the belt.
Welcome, Real Estate Hustlers podcast. I'm your host, Josh Appleman. Today, we're joined with Ryan Duff. He's the founder of Seaport Equity, has 14 plus years in multifamily financing with over $4 billion in funded transactions. His capital stack, expertise, and network of owners, lenders, and brokers make him a trusted advisor and co-investor. Ryan, we appreciate you coming on the show today. If you could, let the listeners know more about yourself.
Thanks, Josh. Appreciate it. As you mentioned, I've been in the space for quite some time. I originally started my career off on the lending side, worked for a large institutional size, publicly traded lender. We predominantly focused in the agency space. And over my 15-year career with them, I structured, as you mentioned, about $4.5 billion worth of debt, working with mom and pop owner operators all the way up to the institutional developer. And really got a good flavor for how the capital stack works, how to structure the appropriate debt vehicles, and put an instrument in place that really helps the economics from an investment standpoint materialize. From that point, I started investing along the way with folks that I developed relationships with outside of just purely professional. And over the past 10 or so years, I've been investing with guys in certain select markets, predominantly in the Southeast, but I'd say up and down the East Coast on a regular basis, on deals where I see meaningful upside. A lot of these opportunities are near and midterm holds, looking for cash flow, looking for appreciation, but really targeting the right owner operator and the right GP team where we can kind of slot in, my personal equity and obviously the equity of the platform that I've since launched over the last year. So I left that lender about a year ago. And since then, I've been raising a series of micro funds, call it $5 to $10 million a piece, closed-ended, separate sets of investors, all retail, coming in from outside the multifamily or apartment industry. And what we do is we raise, as I mentioned, about $5 to $10 million a piece. We invest this capital into a series of, say, 4 to 5 different deals across our select deal profiles and our target markets. And we look to get in and out of these things in a 3 to 5 year period, right? So we'll call capital over a 6-month period, drip, call it 20 or 25% per investment per person. And on average, I'd say we invest anywhere from 1 to 4 million, depending on the deal profile and the return economics, to try to drive cash flow in the midterm. And also look to stabilize, execute the business plan, and exit opportunistically on a staggered basis between years 4 and 5. And that's what we've been doing since.
What are your all's target markets?
Sure. So historically speaking, we're up to about 4,000 doors at this point. Obviously, since the platform took off about a year ago, I kind of created a hybrid model, brought the investment exposure and experience that I had before then, but obviously married that, to the capital that we had been raising from the outside. I would say target markets are pretty simple, right? We love the Sun Belt. We love the Carolinas, parts of Tennessee, parts of Georgia, Florida. We're looking at opportunity in Texas, in the central Midwest up through Ohio. We have some outlier deals, one in Portland, Maine. There's another deal out in Arkansas. So really, we target good demographics, good migration trends, tax-friendly states, both from the landlord and the tenant. And, we're going where people want to move and want to live and either grow a family as a young professional or experience a lifestyle off the coast or outside the West Coast in the Northeast where people can, live in accordance with income, with tax, and have a good place to stay and call home.
Yeah, I'm out of Cincinnati, Ohio, and it's a steady Betty market. So it's predictable. It's Fortune 500 companies, and it's very predictable. It's not massive growth. I mean, there is growth. There's new developing, but there's no erratic upswings or downswings. But I also just got back from Destin, and that market is absolutely on fire. You can tell it's just positive migration. You've got institutional quality assets being built, 300-400 unit apartment complexes outside of the main strip area. But it's incredible. I was telling the wife, it's incredible that people can foresee the demand that there's that much of a demand to build $100+ million asset, and it's going to get filled up. And that's what's happening. They're building them. They're getting filled up. More and more people are just moving to that area. It's incredible to have that kind of foresight. What kind of technologies are you all leveraging to see the positive migration in different areas?
Yeah, so we track trends, right? I mean, we have a canvassing portfolio of probably a couple hundred properties deep at this point. And so what we'll do is, we'll take kind of, the mainstream mediums and the access data point databases to overlay certain markets that we either are currently in or that we want to be in, in the mid and long term. Our canvassing portfolio, as I mentioned, is probably about 200 properties deep right now. We track these assets over a 6 to 12 month period, right? We know who owns these things. We understand the operations, what the occupancy levels are, the DSCR, hurdles. But it's also important, especially in today's environment, to understand what the in-place financing looks like, the debt. We're up against a massive maturity wall right now, and there's a huge debt cliff where there's a lot of bridge loans, there's a lot of construction loans that are coming due last year, this year, and next year. And a lot of these operators weren't able to execute their business plan. They were under stress on timing, cost overruns, interest rate run-ups. They caught them off guard. And so there's a lot of positions from an equity standpoint that people are in right now where they're being forced to make decisions. And a lot of those decisions come with haircuts on equity, right? LPs are no longer answering these capital calls. They can't go out to the marketplace and raise these pref funds or these rescue vehicles to come in and kind of slot the gap and buy themselves some more time, because just like my former life on the lending side, you run out of time, you run out of extensions. And unfortunately, fortunately for us, but unfortunately for the existing ownership or the existing equity, a lot of these moments in time are being forced out and forced exits, right? And so we're targeting a lot of those properties. We have a pretty deep pipeline from a network standpoint into banks and regionals and nationwide lenders. A lot of these debt funds that over-levered themselves over the last couple of years are hanging on to assets, whether they've taken them back or whether they've extended that operation another 6 months to go buy some time to either stabilize, push rents, and exit. But unfortunately, the largest liquidity provider in our space right now, the agencies, Fannie, Freddie, and HUD, their credit requirements are not widening, they're tightening. And so as a result of that, we're seeing a lot of properties get stuck, where in order to exit a deal at a 120 or a 125 DSCR or a 65 to 75% LTV, they're having to slot in some rescue capital or grab a pref or a mezz piece, right? Just to bridge that gap that would otherwise be a shortfall to exit their construction or their bridge loan. So we take all that data into our metrics and we really overlay it in time to get updated real life feedback from how these operations are going. The stress on the operator, right? It's obviously very important to know who's operating these assets, how solvent they are, what their portfolios look like on a global basis. And you're seeing a lot of folks right now that haven't just run into problems on one asset, but it's multiple. And so, you can talk to lenders, you can talk to brokers in the marketplace and really get a good feel for, where the opportunities are, how long they've been out there. We're closing a deal tomorrow. I won't get into details until it's public, but this project went through 3 contracts prior to landing in our lap about 2 months ago. And not only, could these guys not execute, they couldn't raise their capital, they couldn't get the debt financing and the leverage points that they need, but they went under contract about 20% higher than where we ended up being, call it 60, 90 days later. So the market's moving very fast. There's a lot of volatility around us from a rate standpoint, which obviously is driving values and driving, cap rates and abilities for these folks to exit and either get out whole or mitigate their losses.
Why would would it be advantageous for you to come in and purchase it before going back to the bank, or are you buying it back from the bank? Because really they need to be reset at a new basis because they were over leveraged before they were even closed. They were bought on pro forma, a lot of them.
Yeah, it comes in both frames, right? We bought an asset from a bank out of Atlanta, Georgia last year, November. That property was in Wilmington, North Carolina. And to the point that I recently made, the owner operator was a larger fund. They probably acquired 30 assets between 2017 and 2021. They put floating rate bridge debt with no rate caps on every single one of them, right? And so, when the dominoes started to fall, they handpicked the assets that were probably more near towards stabilization than others, and they let the other ones go. And unfortunately, for the lending side, a lot of these banks and lenders put non-recourse debt in place. And so as a result of that, these operators are throwing the keys back to the institution. They're walking away from the asset. Performance and operations go south. They pull their site staff off. There's nobody there to collect rents or, drive new leases or answer maintenance calls. And so what we're doing is we're tracking all of this information in real time. And whether it's coming from a bank or a lender or direct to seller, right? My previous world on the lending side, I worked with hundreds of owner operators across the country. And I still have a lot of those folks in a pretty intimate setting as far as a relationship goes. And a lot of these people are looking for outs, right? And the ability to access this type of deal flow off market kind of drives a pipeline of opportunity for us where, we can make a deal when nobody else is looking at it. We have time to underwrite it. We have time to execute, get the financing in place, raise the equity, because we're a part of the equity on this capital stack. We don't come in and invest 50 or 75% of the equity required to close these deals. I'd say generally speaking, we sit 10 to 30%. But what that does is it allows us to command some preference in economics. We're not your typical LP. We're not stroking a $250,000 check. We're bringing scaled equity, as I mentioned, 1 to 3, 1 to 4 million per deal, which is a meaningful enough size for the GP to go ahead and promote us in the deal, whereby our equity gets treated above and beyond a typical LP check writer would otherwise get if they were just investing directly in the deal themselves. So there's different ways where we command preference, but I think our platform clearly offers a value proposition to both sides, right? Not only do we have the debt access, I'm currently a correspondent and a consultant with my former employer, which allows me to direct debt flow back to them and have full visibility over that process. But we also provide the scaled equity that I mentioned to the operator. And then the value proposition on the investor side is access to deal flow off market that they wouldn't otherwise have, right? And so we're wedging ourselves in the middle, really creating value for both sides, which is proving to be a valuable and invaluable relationship to marry the two together, especially in today's environment where trade volume is down 60% year over year. And there's a lot of people that can't get in front of opportunity. And so we have a pretty predictable, consistent pipeline of off-market access that is being driven to me by, I would say, a tight bench of operators in the market, guys that I know, that I've known for 5 or 10 plus years, that I trust, and I trust do the right thing on behalf of my personal equity as well as that of my investors.
Got it. You all are almost a mezz debt, but not debt. But the capital stack, you're above LPs.
Yeah, I mean, we are an LP effectively in the sense that we don't require control. Okay, like there's certain rights and remedies, obviously, that pref would come into where your equity is going to be treated entirely differently from a rights and remedy and a control perspective than all the rest of the LPs. The proposition that we offer is I don't require a lot of those hooks that a lot of these other pref and mezz providers would. There's an understanding with the operation and the GP level that economically we're being stepped up, right? Control wise, we're not. I'm allowing these guys to do what they do best. These guys own and operate thousands of doors in the respective markets that we play in. And so I don't want to disrupt that. I don't want there to be risk or inherent, kind of sidewinding values where they're going to have to tiptoe around and make sure that we're, being communicated with appropriately or else, we're going to force some type of remedy or exit or refinance, what have you. I don't want to be in that dialogue. That's not the point of what we're doing. We're looking to invest with the right people that have the right access to the deal flow in the markets that we want to be in for the next 3 to 5 years. And as I mentioned, we're commanding the economics to the upside as a result of that, right? We're kind of in a niche space. We're not a mom and pop. We're not an institution. We're kind of sitting in that middle market equity player space, that 1 to 5 million, where, it's inside the family office, it's inside the institution, it's above your typical LP. And there's a lot of folks that are reaching out kind of on a one-off basis, introducing me to the deal flow that they have in other markets, which we are entertaining. Clearly, we're very selective with who we get in bed with, simply because you get one shot at this in this industry, right? And if you have a fund that invests in 4 or 5 different deals with different operators, they all have to have similar execution styles and strategies, and you got to trust in their management systems in order to execute, to make sure that we can realize our returns, which are, I would say, superior from an economic standpoint to the LP than a typical deal would offer, right? So as a result of this preference that we do get, where we otherwise share in the GP promote, structure a pref, or a side letter directly with the GP, I'm able to offer my investors stepped up economics than they would otherwise get at the waterfall at the deal level, right? Because I know that we have this extra cash flow distribution coming into our funds, whereby a typical LP does not. And so as a result of that, I charge a very low fee. I only charge a 1% equity under management fee once dollars are deployed. So clearly, we raise commitments up front. We call the commitments as we need them, staggered over a 6 to 9 month period. And we only charge a fee once those dollars are out in the marketplace working for you. And so dollars that are committed but sitting on the sidelines, we don't touch. And so we're also the largest investor in each vehicle that we do, right? So we're putting our capital where our mouth is and incentivizing our investors to come alongside us to accelerate the growth of our own capital, because obviously the more scale we provide to the GP, the more promotes and economic kind of consistency that we can offer to the group as a collective.
What are some lessons that you've learned while going out on your own and launching your platform?
Transparency, trust. On the lending side, clearly risk is mitigated when you work for a lender where you're an originator of debt. I saw a lot of issues in my later days on the lending side, just given the sheer exposure that the industry had from a variable rate perspective, where they were coming in, putting 85% levered debt in place with no rate caps when rates were effectively zero. Obviously, LIBOR, which is now SOFR, has ripped and caught people off guard. So, the largest expense in your P&L overnight became your debt service. And sometimes 2, 3, 4x what it was when you originated the loan, right? So a lot of these folks didn't project this out. They didn't perform their, assumptions 2, 3, 4 years later and have an interest rate go from 3 to 8 or 9%. And so as a result, that tightened the belt. And so really, from my experience on the banking lending side, I had a tremendous amount of access into underwriting. And so what that did was give me a leg up on how to read assumptions, how to stress exits, both from a income and expense trend standpoint, but also where cap rates could be, where they should be, where interest rates on the exit could be as well. So I've really incorporated a lot of that experience into the equity side. And there's a lot of kind of continuity that goes between the two. And as a result of that, it has given me a skill set to read pro forma projections pretty well. And so that's put myself and our investors in a position where there's confidence, there's more certainty. Clearly, we have a little bit more visibility into the marketplace right now as far as where rates are, the floor, the ceiling, and where they might be going. And so there should be more trade activity going on than what we're seeing publicly. But just from an off-market standpoint, I do know that trades are happening because I'm a part of a lot of them. But also, I see a lot of opportunity coming in from the outside into our platform, where I know that there are deals getting done. And you're not executing right now with, as hard as it is to raise capital, whether you're a fund walking around with $100 million and you're trying to backfill the deal flow, or you're a syndicator up front and you're raising on a per deal basis. the strain on the equity side is prevalent on both sides, right? And so I think transparency is key. Understanding the operator and the management and their reputation is huge right now. Deals are getting done because of who these people are and who these operators are, the deals they've cycled in the marketplace, understanding their comps, understanding how to price, and closing, right? Sellers want certainty of execution right now. And so, when you have maybe two or three bidders on an off-market transaction, and it falls out of 1 and 2, you go to that third bidder at a price cut of 10 or 15 or 20%, you need to know they're closing the deal, because 9 out of 10 times there's a reason why there's a forced exit. Whether it's a maturity, whether it's a fund rollover, these guys have to close and close quick. And so it's really a reputation, platform to be able to execute in the marketplace today. And that comes back, to transparency. And so that I think that's one of the key things why people invest with me, based on my skill set, based on my experience on the lending side and understanding the variables and the levers to pull to appropriately price our equity, but also understanding the capital stack, knowing the right debt vehicles to put in place and which operators to invest with.
Yeah, I think the operator, non-negotiable, and they have to be vertically integrated. They can't just be a syndicator relying on property management, third party, and then another GC and this and that. There's too many people, too many fees, just way too many companies to stay afloat. Vertically integrated, you've got essentially one company under one roof: property management, construction management, asset management, and each one feeds itself. It doesn't have to be all these other companies. I was invited to potentially participate in this deal in Nashville, and their exit cap was at a 4%. And you're talking about a 1980s build on a B- workforce housing. There's just, today is a moment in time. I don't know what it looks like 3 years from now, and I don't really care, but I'm buying it today. What's the exit cap rate today? And how would that make sense at a four cap on that type of vintage, regardless? Because anyone that buys that is your negative leverage.
Mm-hmm.
It's just, but that's a lot of what's still happening, and it's just pie in the sky. Go ahead.
Yeah, I mean, you also have to understand the buyer pool is dwindled too, right? I mean, a lot of these deals where you have institutional players coming in, the return metrics that they can get away with or that they can satisfy their return hurdles with are clearly well inside that of a mid-market operator. So, they can buy those 4 or 5 caps, make those, kind of excruciatingly tight exit assumptions and get away with it because, they can return a 3 or 4% coupon to their investors. That doesn't fly in my world. And in most cases from a mid-market investor standpoint where, we might get in day one to take on, a value add component or a deal that requires a little bit of seasoning. But we're coming in with the positive leverage, as you mentioned. A lot of these deals are loan assumptions where we're assuming a 3 to 4% interest rate, and we're buying at a 6.65 cap, where you're going to have low single-digit cash on cash day one, but we're stabilizing to a high single-digit, low double-digit type yield with an appreciation component, over the 3 to 5 years. So that's the profile that we're targeting, and I think that makes the most sense in today's environment.
Yeah, I mean, if you're buying at a low 4 cap, and then you still need to invest $15,000, $20,000 per unit to then get maybe a $200 rent bump per unit. I mean, your basis is just so tight, and everything's got to hit right. Plus, at the end of the day, you're still dealing with workforce housing, and then you've got to burn off every month on your collections. It's just a different. I mean, what is your take on the different asset classes? On the different, are you all going after B class, or let's wait for you to get back.
Sorry.
No, you're good. What are the asset classes that you all are going after?
So, I don't discriminate, right? We'll go after a BC asset depending on the opportunity and the upside potential, right? Is my background a little shady right now?
It's definitely bright. I'm not sure what happened.
Sorry. All right, there you go. Our profiles vary. We invested in a 3-pack in Northern Florida in November of last year that were loan assumptions where the seller put agency Fannie Freddie debt in place back in 2018, 2019 at call it 3.25%. And we came in, assumed those loans, and we bought at 6.5 caps, and those were 80s, 70s, 80s, and an early 90 vintaged asset. However, we're coming in, we're doing a $7,000 to $10,000 a unit, value add component where we're going to come do kind of a light lift interior upgrade package. The seller has implemented, a few units that have experienced this turn, and they've got about $150, $200 a unit in rent pop. So we're going to continue that program. Clearly, eliminating the variable on the fixed rate debt side, where we have about 5 years remaining to term until that matures. So we have enough time to get in on that type of asset with a fixed rate vehicle. I think we have 1 year of IO left on those 3 deals, which obviously gives us a little bit of cash flow reprieve in the first 12 months. And these are 92 to 93% occupied assets, right? So it's clear that the seller left a lot of meat on the bone where, we can come in, execute the lift, and stabilize within 18 months. On the contrary, we, again, are closing a deal tomorrow down in Charleston, South Carolina. That was a new construction build. And so the builder was a merchant developer where he built the property and it took him about 10 months to get utility hookups. So he had a fully built asset that sat vacant for the first year of a leasing cycle.
Wow.
Because he couldn't get his utilities hooked up with the city. Once that happened, fast forward 3, 4, 5, 6 months later, he was jamming heads in beds below market rents. And he was taking on a lot of tenants that didn't deserve to be there from a credit standpoint. And so the property right now is sitting about 85% occupancy. It's a 2023 build, 288 units, beautiful piece of construction about 15 minutes outside downtown Charleston in an MSA called Somerville, which has great economic employment drivers. There's huge hubs down there in both the auto industry, biotech. There's data centers that are popping up left and right. And so the demographic really supports a premium on a product where we're getting about a 20% discount on a brand new asset, Class A. I'd say it's a core plus opportunity. And so that scenario, to your point about the vertical integration on the management, we invested with an operator that I've known for about 15 years now at this point. He was one of my oldest clients actually in my lending days. And I've been investing with him for the better part of the last decade. He's been tracking this deal since it was dirt and came in, knew the developer was stressed. The developer refinanced his debt into a bridge loan to get out of his construction debt because he ran out of time. He over-levered that bridge exit. And now he's up against a maturity May 1st. And so we were the third buyer on that deal.